ever get to the point where we could really understand it.
But the gentleman's time has long expired. Yeah. So let me move to Councilman Burton from Indiana.
Mr. Paulson, there are those of us that don't agree with your analysis that going about solving this problem was the correct way. You know, if you look at you talk about a meltdown, we have 9.5% unemployment right now. If you take into consideration those who are working part-time or who are getting unemployment compensation, it's closer to 16.5%. There was an article in the Wall Street Journal. So you're talking about how you guys saved the economy and saved the world. We do have a meltdown going on right now, and if you don't believe it, go out to Indiana and look at some of the parts of my district. Let me just ask you a couple questions. First of all, I asked Mr. Bernanke if he talked to you about telling Mr. Lewis if they used the MAC clause that they were going to be fired. And he said he didn't give you any instruction or say anything to you about that. And yet when you spoke, you said that in your testimony, you said you were confident that that was a strong opinion of the Federal Reserve. How did you know that? I mean, there must have been some communication. How did you know? I mean, that you were confident that was their position?
I would say two things there. First of all, you're right that I do not remember Ben Bernanke ever suggesting to me that the Fed...
You don't remember. You know, Mr. Bernanke said the same thing. He said he didn't remember.
But what I do, so you ask where I came away with that view.
Yeah.
And I participated in a number of meetings and calls where Chairman Bernanke participated. There were lawyers from the Fed, staff members from the Fed, people from Treasury, and I came away from those calls with that understanding.
Well, wait. Well, if you came away from that, from those phone calls... No, listen, just a second. If you came away from that, from those phone calls, somebody must have said, hey, we can't let them do this.
Well,
and I would suggest that it might have been Mr. Bernanke.
Well, what I would say to you, I do not know whether someone in those conversations or calls expressly said it, or if my understanding came from just the tone and the forcefulness.
You know, you're a very smart man. I don't think anybody's buying what you're saying right now. I mean, you guys were on a phone call. There was a number of conversations and emails, and you're saying that you didn't get any suggestion from Mr. Bernanke that he wanted you to let them know they were going to be fired if they didn't do what you said?
I said I clearly came away with the understanding that this committee has, and which was substantiated by the emails that have been released and some of the other things, that was the view of the Fed. But I also don't remember Ben Bernanke ever talking about that possibility with me.
It's interesting that both you and Mr. Bernanke can't remember. Let me just read something here that really concerns me. First of all, they expected a $9 billion liability. And a few days later, they found out it wasn't $9 billion, but $12 billion. And so they were very concerned that they weren't going to be able to swallow all of that, and that's why they said they wanted to change this and use the MAC provision. And you didn't want to make that public. You didn't want to make any of this public. Why not?
Well, let me say to you that that is not a fact. This came up in connection with Ken Lewis asking me for a letter from Treasury. And what I said to him about a letter from Treasury is I said, Ken, we do not have any kind of a specific agreement here. We haven't decided on the size of the program, the dollar amount. We haven't decided on how many assets. And so if I gave a letter, all I would be saying is what I've already said publicly, which is that B of A is systemically important and that we are committed to, to not having a failure.
Yeah,
so let me just finish here.
Don't use up all my time.
So what I said was just the opposite. I said if we give you a letter,
Mr. Paulson,
we'll disclose it.
Mr. Paulson, please pull the mic closer to you.
Oh, sorry. If we give you a letter, we will disclose it, was what I said to him.
Here's what was said in testimony. Bernanke and Paulson insisted that Lewis rely solely on their verbal assurance of more support because, as Paulson told Lewis in a written pledge, quote, would be a disclosable event, and we do not want a disclosable event.
Well,
and he goes into more detail than that.
Well, let me say, Lewis has testified clearly before this committee that I never, ever suggested to him that he delay any disclosure. What I said to him was something I would expect you all would agree with, which is if we're going to issue a letter from the Treasury, I'm not going to issue a letter without disclosing that letter. And I don't see the point of a letter because we have no specific agreement. There's nothing to write down. We don't have the size of the program. We don't have the dollar amount. And we've already publicly said...
You gave him verbal assurance, but you wouldn't put it in writing.
I gave him verbal assurance that we were committed to working to get something done.
Why didn't you want to put it in writing? I mean, there's several places where he says that you would not allow it to be put in writing. You didn't want people to know. You didn't want public disclosure. Why not?
Well, because I attempted to answer. I'll answer it one more time for you, sir. I had already said...
Mr. Chairman, will you ask the witness again to speak into the microphone? I can't hear.
Yeah,
Mr. Paulson.
I'm sorry. I had already said publicly, as had the Fed, that we were committed to working to prevent the failure of any systemically important institution, and Bank of America was one. Now, going beyond that, we had made it clear that we were going to be working with him to develop a support program, but we didn't have a size. We didn't have the amount of assets that would be covered. We didn't know what form of equity and how much. We had nothing definitive to say. And so I said, I don't see how a letter is going to be meaningful or helpful, but if I give you a letter, we're going to disclose it. And then that got twisted around to say I didn't want a disclosure.
I know my time's up. Let me just read one thing real quick, Mr. Chairman. Here's what he said. I was instructed that, quote, we do not want a public disclosure. That's what he said, flat out.
Well, he has testified something different before this committee.
Mr. Chairman. Mr. Chairman.
No, I'm sorry, his time has expired.
I have a procedural question. That Mr. Paulson clearly is moving back and forth. Is there enough slack in the mic? The mic could be pulled more to the edge of the table.
Yeah, here we go. I got it.
If you pull it back that direction, maybe it won't.
Thanks.
Thank you very, very much. You know, Mr. Paulson, we're having problems hearing you.
Yeah,
okay. Good. But the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. Mr. Secretary, I want to go back to the line of questioning suggested by Mr. Jordan of Ohio. I also sit on the Financial Services Committee. You testified at least a half a dozen times before that committee prior to the TARP vote. You did indeed, in all of your testimony, along with Mr. Bernanke, express the intent, the central intent of this TARP program was to buy toxic assets to get the economy moving again and to get folks lending again. And you pounded away at that central theme. And what Mr. Jordan was saying, that a matter of days went by and you changed completely the focus of that program. Now, in my opinion, you misled Congress. When you were asked by Mr. Bacchus in the Financial Services Committee, he said, wouldn't it be more impactful, I'm paraphrasing, to just inject the money directly in the banks? And what was your response?
I believe I said right there that...
You said that wouldn't work. You dismissed that. You dismissed that in open committee.
Right.
Which led members of Congress to believe that you weren't going to do that. Now, hear me out. If you had come up here with Mr. Bernanke and said, I got a plan, I want to take $800 billion in taxpayer money, and I want to give it to my pals in the 9 biggest banks of America, how many votes do you think you would have got up here? And that's why I believe you have misled Congress. Let me ask you something else. This conversation that you had a conversation December 22nd, I believe it was, with Mr. Lewis. According to his testimony, you were on a bike ride. And he says that you spoke to him. You were on a bicycle. He was able to catch up to you.
Which date was this?
I'm sorry?
What date was this?
December 21st or 22nd? I actually have it in my notes here.
I happened to be out skiing. It would have been an interesting bike ride. But
Well, he's saying you're on a bike. Well, whether you're on skis or on a bicycle,
okay.
that's not important. I want to know what you said. What did you say to him directly? Give me the gist of this conversation. Paraphrase it if you must, but tell me what you said to him.
Which conversation on the 21st? Because I had two conversations with him on the 21st.
Well, the one in which he says that you stated that there was the real threat or the real
Okay.
possibility, won't use the word threat, that he could be removed and the board could be removed
Right.
under the emergency Fed power, not by Treasury. That conversation.
Okay. This conversation was one where I said to him, number one, that the Treasury and the Fed have communicated publicly that we are committed to prevent the failure of systemically important institutions, and Bank of America definitely is one. Number one. Secondly, that we believed that the exercise of a MAC clause would show a lack of judgment, and if he did so,
This is what you said to him.
yes, and,
Yeah,
if he did so, it would could destabilize both the destabilize Bank of America, Merrill Lynch, and the financial system. And under those circumstances, the Federal Reserve could replace management and the board.
Did you have a conversation with Mr. Bernanke prior to this, that you were going to have this conversation and put it on the line like this?
I had the conversation I had with Ben Bernanke. Did have a conversation before this with Ben Bernanke. I had received a call from Ken Lewis telling me that he had been giving more thought to the situation, and he and his board were increasingly concerned and were considering exercising the MAC clause. And I had a conversation with Ben Bernanke beforehand. But I will say to you, I had had so many conversations with Ben Bernanke, I have a trouble distinguishing one call from another. And the call I had with him was not one where we're saying, now let's get our script down. I had a conversation with Ben Bernanke, told him that I had heard from Lewis, and then afterwards I got back to Lewis with the conversation I just gave to you.
Let me ask you, either on skis or on bicycle, was anybody with you when you made this call?
I made the call I made the call from my living room and a ski cabin in Colorado.
And there was nobody else in the room at the time?
Unless one of the kids were running through or one of the grandchildren, but other than that, I think I was by myself.
All right. My time has expired. I yield back.
Oh, thank you very much. I now yield to the gentleman from Florida, Mr. Micah.
Thank you, Mr. Chairman. Mr. Paulson, you just spoke about some conversations with Mr. Lewis, and if I could just clarify, I guess Mr. Lewis claims that he first learned of the $12 billion financial loss at Merrill Lynch on December 14th, which was 9 days after the shareholder vote. Now, you just testified that he called you at that point and told you he was strongly considering backing out. Is that what you were referring to just a moment ago? Or was it a conversation later on December 21st when Lewis informed you that he was considering backing out because of financial losses at Merrill Lynch?
Well, we had...
There's two conversations, one earlier, which is shortly after their board meeting, when he first indicated, and a second time. Do you recall?
Yeah, there were multiple conversations. The first call was the first time I had any inkling of the problem was on December 17th. And that's when he called. And
well, he said on the 14th that he called you, and that's what we have information. Then there's another conversation on the 21st that he was again very seriously moving towards getting out of the deal because of what he had learned, and he said that is when you threatened to remove him and the board of directors at Bank of America. Do you recall threatening him in one of those conversations?
Well, I don't characterize it as a threat. I clearly recall on the December 21st explaining to him that...
So you did not threaten him either to remove him or the board of directors?
No. What I've testified here today is that that I sure explained to him that the Fed could remove management and the board of directors.
Well, you told folks that all hell would break loose if they backed out of the deal. Is that correct?
I didn't use those words, but I sure told them it would be a very serious problem and it would create financial havoc.
But there were backup plans. Were you aware of those backup plans? Did you disclose the backup plans or ever mention that you had any alternative to Lewis?
I don't know what you're speaking of in terms of backup plans.
Well, it's my understanding that you had information relating to a possible backup plan by British regulatory authority, and that there were backup plans if, in fact, they didn't go through with the deal. You're not aware of any backup plans?
I don't know what
that was the only option?
I don't know what we certainly had we had our TARP, and we were low on capacity in the TARP, but I don't know anything about British.
Well, I have information here we'll put in the record. We've had recent discussions with BAC and ML Management, who contend that they have the required shareholder support and are confident that a transaction will be approved with tomorrow's vote. If approval is withheld, ML will continue to have access to the various facilities and programs currently in place in the United States. Additionally, it is reasonable to expect that ML would be provided necessary support to preclude sufficient systemic disruption. Are you aware of that?
I assume people are just that you're talking about a board report where they're talking about access to Fed lines or the fact that we've got
from the Richmond Fed to the UK.
Yeah, I'm not aware of that.
You're not aware that, and you were never aware of any backup plan. The only thing, and you never threatened Lewis to remove him or his board.
You keep putting words in my mouth. I've now told you 3 times and told the committee repeatedly that of course I told Lewis that we would the Fed had the authority and could replace Lewis and the board.
So you did tell him that you had the authority to remove him and the board.
I told him that the Federal Reserve could replace him and the board if he pursued the course of invoking the MAC.
And again, for the record, you were not aware. You're telling this committee you're not aware of any contingency or backup plans other than you're holding Mr. Lewis and the board to the deal that you wanted to impose.
I'm saying that my plan and my preparedness was to get ready with the support package when the company announced the earnings.
Mr. Chairman, I have some information contrary to what the witness is testifying, and I'd like to ask unanimous consent that that be made part of the record.
Without objection, so ordered.
Thank you.
Right.
Yield back.
Yield to the gentleman from Illinois, Mr. Quigley, Congressman Quigley.
Thank you, Mr. Chairman. Mr. Paulson, I guess I want to put this in context of what didn't happen with Lehman. And I believe the expression you used was moral hazard, which is the notion of bailing out institutions, inviting more risk-taking. Is that a concept, is that a term you'd now not use anymore?
No, I think moral hazard is a very important concept, and I do think when we have a regulatory system that's in balance and you have the wind-down powers that the administration is requesting and hopefully Congress will pass that lets a non-bank institution fail without disrupting the system, that it'll be that moral hazard will have more teeth in it.
So why was Lehman a moral hazard and not Bear Stearns, Fannie Mae, Freddie Mac, AIG?
Okay, I would actually thank you for the question. I believe quite strongly that if Tim Geithner, Ben Bernanke, and Hank Paulson had found something legal we could have done to save Lehman, we would have. And let me explain the difference. In Lehman Brothers, there was a liquidity problem and a capital problem, and we were unable to find any buyer to come in and make the acquisition on an assisted basis or an unassisted basis. And so, although the Fed was able to loan against Lehman collateral and did loan to help facilitate liquidation and bankruptcy, a Fed loan would not have saved Lehman Brothers. In the case of Bear Stearns, we had a buyer, J.P. Morgan, and J.P. Morgan, then the Fed was able to make a loan to assist that acquisition. Bear Stearns, there was a liquidity problem and a capital problem, and J.P. Morgan took care of the capital problem. They were able to guarantee the trading book while the merger was being voted on. AIG was a different situation because in AIG, the perception at the time was this is a liquidity problem only because they had a number of stable, regulated insurance companies that were perceived to be well capitalized and were collateral for the loan. So we faced a situation in Lehman Brothers where we did not have, the government didn't have wind-down powers, the government didn't have powers to inject capital. That came after we got the TARP, and we didn't have a buyer. And so there was no power that we could find to solve both the liquidity and the capital problem.
Did Bank of America request your assistance to purchase Lehman?
Did Bank America?
Yes.
We went to Bank America repeatedly, and Bank America asked each time for more assistance, and we had the private sector ready to fill the gap, but Bank America, in my judgment, was never serious about it because each time they showed less interest, and it turns out they were interested in Merrill Lynch. We had another buyer, Barclays, that we thought was going to do the deal right up until Sunday morning.
Well, let me just ask one more question, given the short time frame. Most of these other groups that were saved, AIG, Fannie Mae, Freddie Mac, their management was replaced. Lewis wasn't replaced. Was his situation different, or in short, did you promise him he could keep his job if he did it this way?
Absolutely not. These decisions for the government to come in and take the responsibility away from the board and replace the board, there's got to be a very good reason. And Fannie, Freddie, AIG, there was good reasons, but I also looked at this very pragmatically and said, these are big, difficult institutions to run. Is the current CEO, is he capable of running this institution? And then you've got to say, who else is suitable to come in and run these institutions?
I appreciate it. My time is up. I guess you could see how that appears to be splitting hairs of who you fire and who you don't fire, and it could very easily be construed to those who are making these decisions in these financial institutions that their first thought must be that they have to listen to whatever you say. They have to play ball, or because you have such discretion, you know, those who play ball keep their jobs and those that don't get fired.
The gentleman's time has expired. Mr. Chaffetz from Utah.
Thank you, and thank you, Secretary Paulson, for being here. I appreciate it. When this country experienced Enron, there was outrage from coast to coast, people who were not informed about the material things that were happening and not happening within that company, because the shareholders were left in the dark. My concern is the lack of transparency to the shareholders and to the public at large, not only as investors, but as investors, as shareholders, if you will, as being taxpayers in this country. So the question that I want to follow up on Mr. Jordan's question, a little deeper into why you did not share this information with other regulatory agencies, for instance, the SEC. Why didn't you feel compelled to share information with them?
First of all, we were working with the regulators that were involved with putting the financial assistance together. That was the effort. The responsibility, it is not a Treasury Secretary's job to get between a company and its and the SEC, for instance. Looking at disclosure, that I've been around long enough to know these are critically important decisions, and that's the responsibility of a CEO working with his general counsel and with the regulator. That's not.
But you were a participant on the Financial Stability Oversight Board. I mean, one of the requirements with TARP was that the Financial Stability Oversight Board, in which you had 2 meetings, and you did not inform the SEC, nor did you inform the Office of the Comptroller of the Currency. Why is that?
Well, let me be, because I take exception with that. After a January 8th meeting of the Financial Stability Board, I sat down with Chairman Chris Cox and I explained to him, it was still early, we didn't have the package together, but we were working on it, and I gave him the details of to the extent we knew them at that time. So on January...
I mean, this thing was fully baked at that point. That was pretty late in the game. Let me go back to what...
No, this was not...
Pardon me. Let me go back to what Attorney General Andrew Cuomo said, quote, that he told Congress in his April 23rd letter that Hank Paulson, quote, informed this office that he did not keep the SEC chairman in the loop during the discussions and negotiations with the Bank of America in December 2008. Is that true or not true?
Well, what Attorney General Cuomo's office was talking about was the question was in December. I also explained to the Attorney General in January, is the Attorney
General's statement true or not true?
I'll
read it to you again. Quote, informed this office that he did not keep the SEC chairman in the loop during the discussions and negotiations with the Bank of America in December 2008.
In December, I did not. That's absolutely correct.
And you feel no obligation. The one agency that is out there as an advocate for the shareholders, you didn't think that was an important effort on your part, or you didn't feel any obligation to share with the SEC or other regulatory agencies?
Again,
even the one within your own agency, the Office of the Comptroller of the Currency.
I would, again, let me say 2 things to make it separate, because you've blurred 2 things. First of all, with regard to the relationship of Bank of America to the SEC, that is something that is not my responsibility. It's not the responsibility of the Fed. That's the role of Bank of America to work with the SEC.
But the Congress did
with the Financial Stability Oversight Board, because this has come up now several times.
Right.
We did not begin to have this together until we brought it to the Financial Stability Board, and there was a full and thorough airing there.
But when was that? Was so far after these deals were already cut.
These deals were not cut. These deals were not cut. That's where there's a misunderstanding. There was an understanding that we were going to work to get something done, but we had nothing specific to bring forward. And the other point I made was on January 8th, in his role as a member of the Financial Stability Oversight Board, I gave Chris Cox a briefing.
I think, Mr. Chairman, what needs to be explored further is that I wasn't here. I'm a freshman. You wouldn't have wanted me here because I would have voted against this TARP. I think it's an absolute disaster. But I got to tell you that I think this Congress, or the Congress before this, did set up this Financial Stability Oversight Board to precisely make sure there wasn't this audacity of arrogance that there would be held in just one or two persons' hands, and that there would be more involvement from other agencies that are very relevant. And to exclude the one agency that is shared and that is tasked with taking care of shareholders, I think is inexcusable, and I think we need to dive into further. I see that my time's expired. Thank you, Mr. Paulson, and thank you, Mr. Chairman.
Thank you very much. I now yield 5 minutes to the gentleman from Vermont, Mr. Welch, Congressman Welch.
Thank you very much, Mr. Chairman. Thank you, Mr. Paulson. Mr. Paulson, I was on that call, I think September, October, when you informed Congress, you and Mr. Bernanke, of the dire condition in the financial markets. And my understanding of what your goals were in Mr. Bernanke at that time were to do basically three things. One, stabilize the financial system. Number two, eventually reform the system. And number three, repay the taxpayer. Is that more or less a fair assessment,
yes.
Summary?
Yep.
I want to go to this, and I share that concern about repaying the taxpayer. When the deal with Bank of America went through, the federal government, and you were very much a part of this, did two things to help in a stability effort. One was the TARP payment of $20 billion, and number two was the asset backing of these mortgage-backed securities of $118 billion, correct?
Yep.
And the intention was that the taxpayer get repaid on that $20 billion TARP payment. Some firms have repaid, Goldman Sachs, J.P. Morgan. And there was going to be an 8% interest rate paid to the taxpayer on preferred stock, correct?
Well, yes, on the second round is 8%.
And then there was a $118 billion backing by the U.S. government in a non-recourse loan that provided assurance to the Bank of America shareholders and to the owners of these securities that the federal government would make good on them in the event that there was a collapse, correct?
Yes. Mm-hmm.
And my understanding is that it was the intention of the Treasury Department that the taxpayers be compensated for providing this guarantee, correct?
Yes. Mm-hmm.
And that guarantee was going to be, as I understand it, in the form of a fee of about $4 billion, correct?
Yeah, I've forgotten the precise number, but that sounds about right.
That sounds about right. And that fee would be arrived at in the ordinary course of what was the customary fee for such a guarantee program, correct?
Yes.
Mr. Lewis is now, and you understood as in your capacity as Treasury Secretary, that in fact the American taxpayer was on the hook to backstop those loans if they went sour, correct?
Well, I clearly understood that we had a term sheet and that the deal wasn't finalized yet, but we were, and then I left office before it was finalized.
I understand that, but a deal's a deal, and you shake hands, and that's all you need. And that's, frankly, I think that's the way most Americans would be,
okay.
Right?
I would say on this one, I know where you're leading. I just I don't have the details because
I'm not asking the details.
I'm not sure why
you
it
as
didn't.
The Treasury Secretary of the United States government, the person filling the shoes of Alexander Hamilton, would agree that when you give your word, you're going to keep your word.
I would expect we would keep the word, but...
And I think you would, and I give you credit for that. My question is this. Mr. Lewis apparently is now saying that there was no deal. He didn't sign it. Even though he benefited by it, he doesn't want to pay back the American taxpayer for the benefit that the Treasury and the U.S. taxpayer provided. Is that the right thing for Mr. Lewis to do?
Well, I don't know what the circumstances are. So I don't know why.
I think there's a lot of things you did well, and I understand you're trying to stabilize the situation. But this, frankly, I think is a simple yes or no. We being the Treasury Department, the U.S. taxpayers, $118 billion of our money at risk. Bank of America took a great advantage of that because that provided stability and confidence. And now Mr. Lewis says he doesn't have to pay for it because somebody forgot to have the term sheet signed. Is that acceptable to you?
Well, can I just explain why I'm hedging on this? Because I was part of doing a similar deal for Citigroup, and we had a term sheet, and then it was very difficult to get it done. And Citigroup wanted to get it done at least as much as the U.S. government, and it was hard to get it done. So what I don't know, if the circumstance was as you presented it, okay, then there'd be one answer, but I do not know why, because I wasn't there. All I know is we had a term sheet, I left government, and the deal didn't close.
Well, I mean, here's the bottom line on that, and this is one of the frustrations. A lot of us voted for that program
Right.
because we felt it was the lesser of evils. We didn't want to. And I remember you on the phone call.
Yeah.
You actually were quite candid in saying the last thing in the world you wanted to do was come to the American taxpayer and ask
Right.
for this bailout. But it was your honest judgment that if we didn't do it, there would be a calamity that would ripple across all of America.
Right.
So you went ahead. We did the same thing, in effect, with Bank of America. Now Mr. Lewis wants the benefit from the taxpayer commitment, the Treasury commitment, and he doesn't want to pay. Most Americans think a deal's a deal, and they should pay.
I would say that if it was a deal, I would think he should pay. And no one was tougher than I was in trying to protect the American taxpayer. And and no one is looking at these programs more with hindsight more than I am in wanting the taxpayer to get the money back.
Well, see, this isn't
So,
hindsight. I mean, this is like a deal with a wink. You know, the taxpayer made a handshake, we're going to cover it, and Mr. Lewis kind of had a wink or had his fingers crossed.
I don't want to take the other side of your argument. I'm just simply being honest and saying I do not know why the deal didn't get done.
I'm sure you can
and the
appreciate.
deal could not get done for three reasons. It could not get done because it was so complex people couldn't figure out how to get it done. It could not get done because he wanted out, or it could not get done because the government wanted out. And I don't know the answer.
Okay.
Gentleman's time has
All
expired.
right. Thank you very much. Thank you,
Right.
Mr. Paulson.
I now yield time to the gentleman from Ohio, Congressman Turner.
Thank you, Mr. Chairman. I want to thank you, Mr. Paulson, for being here and your description of the environment in which you were in and your actions. You know, it's interesting. When we have hearings, we basically try to do two things in hearings. Find out what happened and find out, should it have happened? Why did it happen? Is this the appropriate action? That's the oversight. Why it happened is a factual issue. Now, on the factual side, what we hear from you is that you don't deny that you told Mr. Lewis, don't renegotiate and don't back out. You disagree as to whether or not it was an actual threat for his removal being the consequences, but you told him, don't renegotiate, don't back out. And the why, you say, is because for the American people, you believe it was irresponsible, that the interest of the shareholders of the Bank of America were the interest of the nation, which the financial markets were at risk, and apparently $12 billion is not material for you to believe that a material change had occurred, and you cite your vast experience. Now, you also say that you have taken actions, that there's been removal before. You cite the actions of Fannie, Freddie, and AIG on removal. Those were so different. You had failures of organizations. You didn't have just merely a business deal that was going forward. So they're really not comparable. I mean, I don't think you have an instance where you can provide us that's comparable, where there's a threat from the Treasury Secretary for the purposes of removal of a CEO for a business transaction to go forward, unless there are other threats that you put forward that we're not yet aware of. Now, the thing about your vast experience that just really strikes me is that you really have no exact science with your vast experience. You cite the impact on the markets, your view of this deal, the impressions of how the markets might have an impression, which is not a science. There is no accounting problem from which you made your decision. There is no data point from which you made your decision. And with all the responsibilities that you had, which apparently somewhere around that time includes skiing, there was no way that you could have been up to speed on the economics, the due diligence, the specifics or the details of this deal, to the extent of someone to intervene enough to say, do not renegotiate this deal, and do not back out. Now, I agree with Representative Lynch. I absolutely believe that you misled Congress. And I want to take you back to a meeting that you had with Cheney, yourself, Mr. Paulson, and Bernanke, where you came before the Republican conference to explain your $700 billion bailout deal, which I voted against. You came forward and told us that you were going to buy toxic assets, illiquid assets, and if these were not removed from the market, that we were going to have calamity, and that the crisis was those toxic assets were causing, again, the markets to have instability because the markets had the impression that these toxic assets, having no value, raised questions as to the value of the institutions. I thought it was a crock then, and I voted against it. And then you turned completely away from the toxic assets, and I believe that you were misrepresenting Congress. I don't think it was an issue of just asking for flexibility. I also voted against it because the deal was you didn't tell us who was going to get the money, you didn't tell us what the money was going to be used for, you didn't tell it was how much, and the part that was crucial to me is that you didn't step forward and say, these are the changes that need to be made in our regulatory systems and the laws to make certain that this never happened again. Now, the other thing that was important to me is that I believed that we were about to participate in the largest theft in history. I come from Ohio, ground zero for the mortgage foreclosure crisis. So when you were standing in front of us asking for $700 billion of taxpayers' money to bail out what you called toxic assets for these mortgage-backed securities as a result of the mortgage foreclosure crisis and the credit default swaps, I realized that you were asking me to give taxpayers money to bail out these people who I believe were systematically defrauding my community and the people who were buying houses and refinancing their houses with overvaluations. And I had a great concern, as did my community, that the underlying collateral for these mortgage-backed securities was not there. And that's ultimately what took down the valuation of those mortgage-backed securities. So my question to you is, Mr. Paulson, in your vast amount of experience, since you were in this position in July of 2006, while the mortgage foreclosure crisis was raging throughout the country, and your description of people losing their homes was happening then, not just in 2008 when you stepped in with your TARP program, there were record foreclosures. Mortgage-backed securities were being traded with significant questions, I believe, in the market of the underlying value of the collateral. Subprime mortgage lending was spiraling. Refinances were increasing based on inflated and escalating property values. Where was your vast experience then, and what do you believe we should have done in 2006 to have stopped this?
Well, first of all, if you are making the comment that I did not see this crisis coming to the extent it came, you're absolutely right. Okay, I, like many others, underestimated this then, number one. But what I did do very shortly on arriving was began preparing for a financial crisis. I began meetings with the President's Working Group on preparations, number one, and number two. Although I would take exception with a lot of the things you said, I began working on a plan which we had announced in March, well before I went to Congress, to overhaul this outdated, inadequate regulatory system. And so we came out with that in March, came out with recommendations that we needed the authorities to wind down these non-banking institutions if they get in trouble so they don't have to be bailed out. The only other thing I would say to you was I am not disputing the fact that when Ben Bernanke and I came to Congress, we understood that illiquid assets, because illiquid assets were at the heart of the problem in the financial institutions. That was at the heart of the problem. That was a major cause for the losses, for the illiquidity, and so our approach was to buy those illiquid assets. That was our primary approach. And we learned, and as the situation began to crumble all around the world, and it was so clear we had to move quickly, we needed to change gears. And I made the decision that when the facts change, you need to move quickly and change. And I'm just saying, the only point I was trying to make wasn't to say we didn't come to Congress and ask for illiquid assets, But thank goodness when we came to Congress, we also asked to have some flexibility, and Congress gave us the flexibility. And the last point I would make is the people I care about are the same ones you care about. The American people, the people that are going to lose their jobs. And the tragedy is they didn't create the problem. It are the big banks that created the problem. It's a whole lot of, the problem was created not by them. But they would be the one that would pay the greatest penalty if there was a collapse. And so that was what I was working for.
Gentleman's time has expired. I now yield 5 minutes to the gentlewoman from California, Congresswoman Spear.
Thank you, Mr. Chairman. If the people of America didn't create the problem, who created the problem?
If the people of America didn't create the problem?
You said the people of America didn't create the problem, so tell us who created it.
Well,
were the banks involved?
Well, I would say this problem. There's so much blame to go around. It's hardly.
Well, give us a few people,
okay.
few institutions.
Well, you look at excesses had been building up for a very long time.
I just want you to give me some names. I have a limited amount of time. Would we include
okay,
the banks? Would we include Goldman? Would we include AIG? Would we include anyone who got TARP funds?
You could say financial institutions, regulators, investors, so that there was plenty of mistakes by a vast multitude.
You'd be interested in knowing that in a financial services committee yesterday, all the banks were represented, and they almost to the person indicated that they weren't responsible for this. But let me move on. Do you use email?
Do I use email? No, I don't use it personally.
You don't use it personally or professionally?
Yeah, I just don't. So I've never used it for any business communications. Just never use it.
So while you were Secretary of the Treasury, you never used email?
No.
How did you communicate with people?
Telephone.
All right. Did you know Mr. Lewis before you were Secretary of the Treasury?
Yes.
For how long?
4 or 5 years.
Did you know him socially?
No.
But professionally, you knew him?
Professionally, I know him, yes.
Okay. When you gave B of A and Mr. Lewis $15 billion in October, he didn't want it, we were told. So why did you give it to him?
Well, that is certainly not my recollection, but let me tell you why we gave it to them.
Very briefly, because I have a second question I want to ask you.
Okay. Then, very briefly, after we got the TARP authorities, and when the system was on the edge, and we needed to move quickly, we decided that the only way to do something that was going to be dramatic and make a difference was going to be to get capital out quickly and get it out into 9 systemically important major institutions. So we called them together. The regulators let them know what the recommendation was for each institution. And Mr. Lewis, like the other CEOs there, very willingly agreed to take that capital because they recognized that they had as much to gain as anyone from the stability of the system.
All right, so you gave him $15 billion in October, and then another $10 billion in January 9th, and then $20 billion on January 20th. It's interesting that that amount of money equals about $45 billion. They paid $50 billion for Merrill Lynch. In many respects, I feel like the taxpayers bought Merrill Lynch for the Bank of America.
Well, I would say this to you. The taxpayer is benefited in 2 ways. First of all, I would be very optimistic that the taxpayer will get all of that money back with a profit, number one. And secondly, what the taxpayer got was an averted calamity. Because if we'd had the financial system collapse, the taxpayer would be the people that would be hurt.
All right, let me ask you this. This press release went out from your office as Secretary of the Treasury on January 16th. And this press release talks about the package to the B of A and specifically says that the Treasury and the FDIC will provide protection against the possibility of unusually large losses on an asset pool of approximately $118 billion of loans. So this ring fence was a done deal on January 16th.
Well,
when you were Secretary of the Treasury.
we worked out the details and put out a term sheet, but this deal was not closed then. And I left Treasury.
Well, how could you possibly say this publicly if it wasn't closed then?
Well, because
it wasn't a deal. So were
we-
you giving him something or giving B of A something that they didn't actually have to agree to, but give the appearance that they had something, and then they could renege on it?
Congresswoman, I have no idea what happened after I left. So,
But how professional is it to put out a statement in a press release that something has been consummated when it hadn't been consummated?
listen, we tried to...
I mean, that's kind of like
I'm getting...
Contracts 101.
No, I'm getting it from both angles here. People wanting me to put out letters when there's nothing to disclose. Here what we did is we communicated to the market that we had a term sheet. The market knew that this deal wasn't closed yet. We were announcing a deal with the intent of closing it. And why it didn't close, you'll have to ask people that are at Treasury today.
Mr. Chairman, I certainly would hope that we would question further who was responsible at that point in time for these negotiations so we can have them come before this committee. I yield back.
Good point. Thank you very much. I now yield for 5 minutes to the gentleman from Indiana, Mr. Souder.
Mr. Paulson, had Mr. Geithner signed off on that memo, the terms of the deal?
What would you say?
In other words, you were just about to transition between Treasury secretaries. Had Mr. Geithner or the incoming administration signed off on the tentative terms?
Mr. Geithner, as you know, was the Treasury Secretary designate, and we wanted there to be a very smooth transition. And so I posted him generally on a number of matters, including that matter, but I never viewed him as a decision maker, and I certainly didn't go to him to sign off on the details of that term sheet.
I have a larger question I want to pursue off of Mr. Lewis, but I want to correct the record on some things that I think have been misstated. As somebody who voted for all three versions of TARP, took incredible political heat in the middle of a tough targeted race, I believe it was the right thing to do, and I would do it again with some additional caveats. But there's been a lot said today about the restrictions that were put on you. In fact, you came, in my opinion, not very tactfully, and told us that you wanted basically a blank sheet of paper with whatever you wanted to do. Initially, they didn't need any Republican votes. Paul Ryan and others in our caucus negotiated some 20 pages of additional things. But the bottom line is that we left there, or the Secretary of Treasury and those responsible can do whatever they think they need to do. Now, we can try to pass blame, we can try to say whatever we want, and in the future we probably need to tie it down more. But at the end of the day, our conference, after hours of internal debate, knew that given the nature of the crisis, we had signed a blank check, for good or bad, that we were going into an election season, we were about to leave town, it was getting highly politicalized, things were changing. I'm not defending the decisions that you made. I'm just saying it's a little bit much for members of Congress to claim that there were all these guidelines in place because we knew full well you had an opt-out clause. Now, that said, clearly you misled us, and we probably wouldn't have had the votes, even though we underneath knew that that was there because we understood it was toxic assets. We didn't believe you were going to take over and the way this was going to evolve. Had we known that, the bill would have never passed, or would have put tighter restrictions in. Because what I would say is there was a verbal misleading, even though if anybody read the document, it actually gave you a total blank check. Now, I would also say, I don't understand where people are saying that we weren't in a crisis. Every 48 hours for 3 months, somebody was calling me, telling me a bank was either calling their revolving loan, the mark-to-market was tightening up their assets, so the banks were having their assets drop, people who were never late in their history, people didn't know how to get their payroll dollars, major corporations in this country were having to borrow overseas from third world countries in order to meet their payroll, and that I don't know where it would have gone. I represent a district that is the highest unemployment in the United States, that I have either, Elkhart County has been first in unemployment all the way through. but they're 57% manufacturing. They're 17.6% right now unemployment. We were headed to a lot more than we are now. I'm not necessarily happy with everything that's happening, but it could have been a lot worse. I don't know how catastrophic, but in fact, it's relatively stabilized. And I think we can have differences of opinion of how to do it. Now, here's my concern about what I saw on the Lewis thing and where it's evolved. When you intimidated, at the very least, Mr. Lewis, into saying the government's going to do it, somewhere in here we went from toxic assets and loans, and your stated goal to us was we didn't want the government micromanaging and directing. That was the next step, the Lewis process. Then you say when you handed it over, you thought you had a process, but then you don't really know what happened after that. Since then, we now have common stock in banks. We're telling them on bonuses. We're micromanaging. Tomorrow, we have a proposal, now that we've taken over stock in GM, to tell GM that they can't close dealerships. Now, this is the problem when government starts to take over. If you were Treasury Secretary now, where would you have started to draw the line here? You started to walk into it with Mr. Lewis when you realized that could kind of scrambled. Would you have moved to common stock? Do you believe this has gone too far? What lessons can we learn from what we've seen here? Because right now, the government is in so deep that getting out is going to be very difficult, and we're micromanaging, and Congress is going to start to tell people what kind of tie they can buy if we're not careful.
To me, that's the right question. And one of the things that was most difficult for me is I came to the job believing totally, and I still do, in markets and free enterprise and not wanting to see government overly involved. And so I was forced to make some decisions which were very objectionable, but they were better than the alternative. And I thought the decisions we made were going to ultimately help to preserve the markets. So I think the key question is not only how do you get into these programs, but what's the right exit strategy? What is the right exit strategy? When is the system stable? And when do we get out? And I don't think that it is appropriate for me, as a former Secretary of Treasury, 5 months out of the job, to be, and not any closer to it than I am now, to be saying more than that, other than because I think everyone here understands that that government has been forced to do things. I think forced to do things by not only a unprecedented crisis, but forced to do things because we didn't have the tools we needed. There were not wind-down authorities. There was nothing to deal with the failure of a large non-banking institution other than the bankruptcy process. There was, and we had a really outdated regulatory system.
But it's fair to say that even under great pressure, you didn't take common stock.
Yeah. Yeah, I did not.
Let me, the gentleman's time has expired, and let me just do a little housekeeping here. We have 7 votes on the floor, so the committee will recess until 1:30. We'll return back at 1:30. Huh?